You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. So last week we looked at a trade. We always talk here on Options Playbook Radio. It's just about learning. We're not here trying to make recommendations, but we're trying to learn more about option pricing and how it equates to the strategy. You can pick your underlying and make your forecast, but we're looking at conditions where we're really trading volatility and what's going on in the markets more so than we are trading the underlying. And last week was a perfect example of that. We looked in the S&P 500 index. We looked at a butterfly on a one-day butterfly because we saw the volatility index trading up around 19. So we're going to discuss that a little bit today, and then we're going to go back and do a rinse and repeat. The Roku trade that we did a while back, we did a paper trade on Roku, and we just talked about the volatility and the fact that the market came crashing down 50, 60 points, and that didn't think the volatility was going to stop, but the options market was not reflecting that. So we actually did a position, a long strangle in the marketplace, and then we sold some options against it. So we're going to look at that again because Roku has made another big move, and there's more news to be coming out on the story hasn't ended, let's put it that way. So to go back and look at last week, let's talk about the trade and exactly what had happened. We taped it on a Wednesday. The market was open. We taped it right around lunchtime, and what I did note is that the implied volatility of the one-day option contracts were still fairly high. They were trading around 19% implied volatility, which is where the VIX was at. So it kind of made sense that the VIX was very close to what the volatility was for the near-term option contracts. But the VIX is a 30-day weighted index, just so that we know that the VIX is based off of 30-day options. The general VIX symbol is based off of 30-day options. And we were looking at one-day option contracts. Well, bottom line is we did a 10-point wide butterfly. The market was at 29.15. We bought the 29.05 call, sold two of the 29.15 calls, and bought one of the 29.25 calls. The total cost of that trade was $2.65. And I mentioned that normally that would not be the case on a one-day butterfly, actually just even a half-day butterfly. So fairly inexpensive to put on that trade. And we knew that the 29.15 call option had to go away. It had 1 day to live. It was a Wednesday expiration. We talked a little bit about that. And on the close, all we really needed it to do was really stay within the strikes. The actual break-even points were 29.05 plus the 265, so 29.0765. And then on the upside, it's 29.25 minus the 265 debit, or 2,922.35. So we had a good range, and you just kind of say to yourself, well, why not? Volatility is high today for some reason. The S&P 500 index offers a lot of expirations to deal with. Let's just see what a butterfly is trading for. And if we do think that that market can stay within that 20-point range from 29.05 to 29.25, we're going to probably feel pretty good. So we put on that trade, and I even mentioned on the call that one of the things that's really nice on the S&P 500 index is I don't necessarily even have to get out of the trade. As long as it's within the range, it's a cash-settled index, and so you'd put on the trade, let it execute. You can manage the risk if it goes outside, but your risk is limited to the debit paid, $2.65. So if it did go outside of the range, you can try to manage it. But if not, you just let it expire. And if you waited all the way to the close and you didn't trade out of it, the market closed at 2,919.40, basically $4.40 above where our short strike was. So on the entire trade, at $4.40 minus the 10-point wide spread, that would be $5.60. You paid $2.65, so $2.95 would have been the profitability on that trade. Now, if it went outside the range, we could have lost that whole $2.65. So you always talk about that, and don't forget about commissions when you're doing trades. Commissions have came down precipitously over the last week. A lot has happened in the brokerage industry. But with that said, you always got to add that into your trades, and that always does weigh in, without a doubt, on the S&P 500 index option contracts. Okay, so the only reason why we did that was the VIX. It had nothing to do with the forecast on the underlying, except for obviously we wanted to stay within the range. We're hoping it would. But we would not have done that trade if the VIX wasn't at 19. So in this instance, if we look at the VIX today, we see that the VIX is now trading at 13.94. Guess what? We're not going to do that trade today. That's not going to be the Options Playbook Radio learning paper trade for the week. So we're going to go back and we're going to look at Roku. Roku, we did a trade when the stock was trading down around the 110 level, and we went out further in time, and we bought a 110 call, and we bought a 110 put. And Roku has been all over the place since then. If you just look at the charts, there's been good news, there's been bad news. It went down, it went up. The biggest thing was we gave ourselves enough time for that entire trade to play out. And since it was down at 110, we've seen it up as high as 133, as low as 100, very close to on the low end. And why not do it again? I don't think all the news is out on Roku. And once again, as always, the theme on Options Playbook Radio isn't that we have a view on where Roku is. We just have a view on volatility. We think the stock is going to receive some more news. We don't have any idea what it's going to be, positive or negative. So we're going to look at doing an option strategy that benefits if the stock either goes way up or if the stock either goes way down. So in our instance, I think we would stay, we still have extremely high volatilities overall to be buying option contracts. If we just look at the options that we're going to be dealing with, first of all, we should probably note that right now the anticipated earnings date is on the 6th of November, so we've got to be aware of that because that's going to even add more volatility to a volatile situation on the 6th of November after the close. So the expirations that we have, the normal expiration is November 15th, and then there's a real volatile expiration that's a weekly option contract that expires on November 8th, right after the earnings announcement has been anticipated at least, and then November 1st expiration. So we're going to just totally avoid that earnings. We're going to look at the November 1st expiration, and we're going to take where the current stock is at. And I should mention that we are taping Options Playbook Radio. Today is Wednesday, October 16th, and the markets are open, so the markets are moving. We see Roku last traded at 133.57. It's up 75 cents on the day, so it's definitely made some moves, without a doubt. And if we look at just buying, and we're just going to work off the midpoint here, if we are buying the at-the-money 134 call and the at-the-money 134 put, the flat-out straddle in Roku, that trade would be trading for, or that strategy would be trading for $15.80. So, if you do not think that Roku can move at least that amount over this period of time, which is going to go out until November 1st, if you do not think it can make that type of move either to the upside, and it's got to be directional based, either to the upside or to the downside, then you don't want to do this trade. You have 16 days remaining to expiration. Comcast came out and announced that they're going to have a product that will compete with them. Roku came out and announced that they're doing some deals with Apple. There's just a lot of movement in the space. Netflix is announcing earnings tonight after the close, which you can kind of say competes in the space a little bit. And then we have a lot of streaming services that are coming online, including Disney and Apple coming out with their new streaming platforms that are going to compete with Netflix. So there's just a lot of news in this space and a lot happening and a lot of shakedown that's going on. So here's what we're going to do. We look at the October 18th expiration in Roku. It's only got 2 days left. So basically got a half a day today, and then you got all day Thursday, all day Friday. And those are trading at extremely high volatilities, up around 80 or 90%. So we're going to try to take advantage of that. We're going to go in and we're going to buy the 134 straddle, the call and put. And like I said, that's trading for about $15.80 at the midpoint. But then we're going to sell some premium against it, just 2-day premium, because we don't mind if it makes that move over the next 2 days. We prefer that it didn't make a huge move, but it would take a directional basis. And we're going to sell the October 18th 125 put on the downside and sell the 145 call on the upside. So we're talking about 10 points approximately, based off of the strike prices, approximately 10 points up and 10 points down. In our instance, it's actually going to be 9 points at the 125 strike put on the downside and 11 points on the upside, 145 strike put, considering that the strike price that we're going to be buying the long straddle at is 134. Now, that entire trade now brings in a good amount of premium just for 2 days, 10 points out of the money. We're bringing in almost a little bit more than $1. So the midpoint of this trade, and this would be our total risk, all the way up to that first expiration date, is $14.11. So $1,411 if you want to put this trade on. We're trying to bring in some of that premium to help pay for it, and then we just want that stock to rock going on up into November 1st expiration, 16 days away. We just need it to rock either to the downside or to the upside. And don't ever mind logging out of a long straddle if you put on the trade. I just want to make sure that if I do, I'm going to log out on either side, and it's going to at least pay for my trade. So I'm not going to log out of the call on the upside unless it's trading it for about $14, and I'm not going to log out of the put on the downside unless that's trading for $14. All right? So I want it to be at least $14 in the money, and then we'll probably get some premium to go along with it. But I would prefer to get out of this trade sooner than later. As expiration approaches, if the stock is not moving and I'm down to the last week, I'm just going to probably get out of the trade, and that would be the approach. All right, so let's go back and rehash it. Roku's been very volatile. We did a long straddle not that long ago, and definitely was profitable. There are many, many different opportunities that you could have got out and been profitable on that trade. Now we're going to look at doing the same thing, do a rinse and repeat. With the market open right now, we got the last trade on Roku at 133.57. Stock was up 75 cents so far on the day. We're going to buy the 134 call and the 134 put, and then we're going to sell some calls and puts against it. We're going to sell the October 18th 125 put and sell the October 18th 145 call. We're going to do this entire trade for $14.11 for every 1 by 1 by 1 by 1 that we put on, we're going to pay a net debit of $1,411 plus commission to put on that trade, and that's going to be our max risk. We definitely want to keep an eye on it over the next 2 days for sure, because we're going to have some short put and short call exposure. But our idea would be that we collect those premiums, which is about $1.70 in premium, and we're hoping to get that over the next 2 days. And then we hope the stock starts rocking either direction. At least a 15-point move is what we're looking for in either direction. And if we do, this trade should do well. All right. That's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.li.com. That's theoptionsguy@invest.li.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.